Hi, everyone. Now it is my distinct pleasure to introduce our guest, Mr. Miranda. Mr. Miranda is the Chief Investment Officer of the Cornell University Investment Office, where he oversees the university's $10 billion endowment. Previously, he was the Director of the International Monetary Fund's Investment Office, where he oversaw the investment of approximately $11.5 billion of assets. And formerly, Mr. Miranda was the President of the Board of Directors of the Bank Fund Staff Federal Credit Union, which is one of the 50 largest credit unions in the United States. Now it's my honor to welcome our guest, Mr. Miranda. Thank you so much for joining us today, and the floor is yours.
Thank you, Zunian. Pleasure to be here. I am counting, though sometimes with the screen it's a little bit hard, but 5 of you, is that roughly correct? Okay, I'm counting 5. Look, this can be very casual. We have about 45 minutes. Let me just start out by asking if there are particular angles or elements that along the path of my presentation people want to know a little bit more about. Sort of, if any of you who are in the audience have particular interests, let me know and I'll try to address them. So let's spend a couple minutes just seeing if there are any questions. Okay.
When you're first, can you mute that? When Cornell, sorry, Zuni, can you mute your volume? I don't want to listen to myself. When Cornell loses a lot of money, and then you think that eventually the investment would improve eventually, and it keeps on getting worse. How do you alter your strategies so you end up still making profit and helping the university from a financial domain?
I'll try to address that, certainly. Any others? Okay. So first, I have kind of a rough outline of what we can talk about. I'm going to talk a little bit about the nature of an endowment. First of all, I think that's very important, especially if any of you are aspirationally looking to get into the endowment or foundation space, so that you're a little bit aware of what the nature of a role like mine is, or a role of my team. I can speak a bit to that career perspective wise, but also to clarify, because I think when a lot of people think about investments and finance, they tend to think about banking, investment banking, mutual fund management, etc. And I do want to kind of distinguish what an endowment does career-wise, if you're interested in it, versus what you would do if you were to go after college to an investment bank, a commercial bank, and a mutual fund complex, etc. So let's first talk about the nature of an endowment. So an endowment is really the accumulation of financial gifts. It's intended for the ongoing support of an organization, and typically the goal is to keep the principal amount intact and also retain some of the capital appreciation, but simultaneously to pay out 4 to 5% a year. So from our endowment, we typically pay out 4 to 5% a year, and we use a formula that averages over the past 7 years. So in any given year, it might not be 4 or 5%. When markets rise sharply, that number will drop below 4 to 5 because the current value is much higher than the weighted average value. Likewise, when markets fall sharply, it'll be more than 4 to 5% because the current value is less than the weighted average. We intend to support both short-term needs, especially current students, financial aid, other constituents, and longer-term needs, future students, capital needs. I don't know if people have ever heard the term intergenerational equity, but the concept is we are trying to make sure that we don't spend entirely on the current generation, that part of this is for the future of the institution and future generations of students. We sometimes provide general resources for an institution. In terms of governance, we're overseen by a board of trustees and or an investment committee. That's very common. You look at, any of the Ivy endowments, same structure. And sometimes endowments and foundations outsource to a third party, like what's called an outsourced chief investment officer model. And there are many firms that do this. One in the Washington, D.C. area is called Strategic Investment Group. They manage endowments and foundations for some 30 different organizations. Before I go on, any comments on that? Any questions? Okay, so our objectives are to preserve capital and to have growth of the endowment in excess of spending and inflation. So if we pay out 4% and inflation is 3%, for example, that combination is 7%. If you don't earn 7%, then the value for your endowment in real dollar terms falls. So we try to preserve capital in inflation adjusted terms. And as I said, we're trying to support intergenerational equity and stably support university programs. Now, here's a big distinguisher. Very few endowments or foundations actually manage cash, manage securities, manage bond portfolios in-house. Some do, but in most cases, we use an outsourced model where we manage, we in essence select managers to manage on our behalf. And we try to do it in a way where our manager selection cuts across numerous different asset classes. So we'll have a certain set of managers for, let's say, U.S. equities, a certain number of managers for non-U.S. equities, a certain number of managers for emerging market equities, managers for private equity, managers for high yield, managers for real estate, managers for resources, managers for core fixed income. We're basically managers, but the trick is putting together a set of managers that makes sense from an overall portfolio composition perspective. One thing that I think I'll make one more point. This isn't in the slide. One point to make is, I think people think of an endowment like a university endowment as if it's one endowment. And while we manage as if it's one endowment and we hire managers across the whole corpus, in our case, we're about $10 billion. But every loyal alum who has donated to Cornell has a different purpose in mind. So one alum might donate to endow a professorship. Another alum might donate to support a lab of ornithology. Another alum might donate to support a deanship. Some will support graduate student research. They all have different objectives, and each of their sub-endowments is paid out for that particular objective. So sometimes when people say, "Oh, it's the university endowment," it actually isn't. It's actually the university set of endowments, plural, and often I think that people don't understand that. We pay out for a variety of purposes depending on what the alum want to do. And I typically say alum, it doesn't have to be alum. It can be a generous donor. It could be someone who likes the mission of a particular research institute. It could be all sorts of different people who support the overall objectives of the university in general. Some part of the endowment is university funds, but I think there's this sort of odd thought, and you all are all applying to colleges now. I think there's this sort of odd thought that universities run profits and losses, and the profits go into the endowment, that it's in essence the retained earnings of the university. It's very rare that that's the case. Most universities run on a cash flow neutral basis, and so they're not accumulating large assets that are, let's say, the profits of the university. That really doesn't happen. There are lots of reasons budgetarily and tax-wise why that doesn't happen, but there are cases where a university will have, or a department will have, a long-term plan, and let's say they're trying to build a building. Let's say the College of Arts and Sciences needs a new building, and they run a campaign and they raise money, but they know that this building plan is going to take 5 or 6 years. They might set aside those raised monies into the endowment, but they're not really setting aside tuition dollars. So that's just to kind of clarify what an endowment does. In terms of what are investments in an endowment, I already alluded to this. It's a really broad range of things. We hire lots of managers to do this on our behalf. Equities, fixed income, hedge funds, private equity, real assets, lots of different things. What are we trying to do? We're trying to diversify as much as possible while meeting a certain return objective. I'm going to again pause and just see if I'm making any sense, whether people want to ask additional questions, any interjections at all.
Oh, yes. Oh, sorry.
I had a question. So, when you say that like there are multiple like funds for investments, and that the Cornell Investment Fund like oversees all of them. So in each individual fund, are there like different do you invest in different things than other funds, and how so, like how is each investment managed? Like how do you go about like pitching an investment to that group of people?
Yep. So I'll go the direct answer is no. If you go into the endowment, you're getting the strategy of the endowment. You do not get a special asset allocation. If you say, I only want to invest in technology stocks, you don't go into the endowment. The endowment is being managed professionally. It's being managed across asset classes. It has a certain risk return objective. And so, no, the answer is no. We don't customize each individual's contribution in the way they want to. Now, the other, maybe the complementary side of that, let me give an illustration first. If you ever purchase a mutual fund, right? So you're purchasing a mutual fund, you and a million other people are purchasing that mutual fund. The mutual fund only has one strategy in it, and you're in essence getting a pro rata share of that one strategy. So that's kind of the same thing that's going on here. These 8,000 sub-endowments at the university are all getting a mutual fund accounting, and in essence get the asset allocation and the strategy of the overall endowment. I hope that was clarifying. Okay, so I am going to just switch over to what does a university endowment look like? This is an average over all endowments over $1 billion. And it's a little bit color coded, not perfectly so, but the blues, the light to the dark blue, are all equities. So it's, domestic equities, meaning like the S&P 500, non-US equities like European stocks, Japanese stocks, and included in non-US equities would be emerging market equities, private equity, and venture capital. Those are all equity pieces. You can see the average allocation is highly geared towards equities. If you add up those numbers, it's about 65%. I haven't added them up recently, but it's quite a bit, 30, 45, 50, 56% equities. The green slices are real assets. So this could be anything from real estate. It's primarily real estate, but it can also be things like commodities in general, metals and mining companies, agricultural companies, timber. These are typically held in a portfolio because real assets have an inflation hedging characteristic. The orange is marketable alternatives. That's typically things like hedge funds, but can also be other liquid alternatives, but typically things that you can't redeem quickly, but you can exit within, let's say, 30 days. There's private debt and there's fixed income. Fixed income is, you want to buy some 10-year treasuries or some corporate bonds. So that's kind of, if you look at it, like just step away a second, the takeaway here is most endowments are mostly equities. And then you have these other pieces that help enhance return and moderate risk. So what we, excuse me, I started by saying, look, career-wise, you may want to go into investment banking. You may want to go into commercial banking. You may want to go into mutual fund management. That's a very different space in the whole financial market spectrum. And endowments typically are the consummate long-term investors. We're not investing for the next week or the next month or the next quarter. We're investing for a very lengthy period of time. So we can maintain our biases towards equities through bull markets and bear markets. There was an earlier question, what do you do when something goes the wrong way? Well, you do reassess, but you're patient. You have plenty of time to sit on your hands. And we see plenty of cases where people panic and accelerate the sell-off. And you typically see that in a bear market. Global financial crisis, which was long enough ago that most of you don't remember it. But we've had a recent COVID scare. Markets went down sharply. People panic. Well, what did we do? We try to assess whether that is a permanent feature or a temporary feature. And if we assess it to be a temporary feature, we'll just cost average in. Now, you do have managers who are in an area of the capital markets where, hey, there's no hope for this. There's been a change in regulation. There's been a change in investor sentiment, and people want to sell out of that asset class or that manager or that strategy. And certainly we're looking at, does it make sense from a fundamental perspective, or is there something else going on that says, hey, we need to exit this strategy. Sometimes we will exit the strategy until the strategy might make sense again. Something that might be a little bit too technical for this for this conversation. during the the last decade, value stocks didn't perform well compared to growth stocks. Everything was about technology the past 10 years. Does that mean value investing is not a good strategy? It probably means it's a strategy that's out of favor. It's out of favor for 10 years. And you need to start thinking about how much you have in value versus growth. And you also need to think about what is the trigger point that you want to go back into value if you've cut it back. So that's just an illustration, but to put a little bit more on it, we don't, as I said, we don't trade. We're not traders in an office. We're not a mutual fund. We're not an investment bank. We're not a hedge fund internally. We have managers who do that on our behalf, but we're not traders. There's a lot of adrenaline from trading, right? It's, the good news is you go home, you wake up stressed and you go home stressed, and then you do it again the next day. And some people really like that. That's not what endowments do. When I say stress, I don't mean negative stress or negative anxiety. I mean people who just like the challenge of the marketplace. So we maintain this long horizon. We're deeply and globally diversified. We emphasize both relative and absolute value. I'll give older examples, but relative value could be what I just said. Do you invest in value stocks or growth stocks? At a certain point, value stocks are very cheap compared to growth stocks, and that would be a relative play. An absolute play would be something like, I'm going to have to use some history, but back in the 1990s, a number of banks called S&Ls, savings and loan institutions, went bankrupt. And they were major lenders to commercial real estate, and they were forced to sell their commercial real estate in a very short period of time. It created enormous stress in the commercial real estate market. Real estate values were absolutely attractive, and you could also relatively attractive, but you could buy real estate at 50 cents on the construction cost measure. And so you can look for indicators that are relative, and you can look for indicators that are absolute. Today, one area that one should look at is commercial real estate, office space. With all of the advent of hybrid and remote working, the demand for office space has fallen off a cliff, and therefore office owners are having a hard time keeping their buildings leased up. Vacancy rates rise. And the one thing you should know about a building is, there's very small margin. A change in occupancy by 5% could mean all the difference in the world between being profitable and losing money. Some of these things, I'll just say, we maintain liquidity for optionality and rebalancing. We avoid market timing in general. We have a long-term strategy. We're not trying to say today we're 50% equities. Now we don't feel good about equities. We're 20% equities. It's a very slow moving sort of evolution of strategy. We try to keep management fees low, fees and costs low. What are we thinking about these days in terms of investing? Everyone has read the papers about inflation, and what protects a portfolio when inflation rises? Bonds don't do well. Equities typically don't do well in the short run, though they do tend to be a hedge in the long run. Real estate does relatively well. So does commodities and resources and timber. We're also in a huge energy and carbon transition. There are going to be opportunities that come from that. It could be everything from the growth of lithium mining to the growth of copper mining. It could be who are the new who will replace Ford, GM, Toyota, and Honda in terms of technology. One needs to think about those issues. There's a U.S.-China rivalry that's clearly in play right now. Environment is a huge issue in.
Oh, hi, Mr. Miranda. I'm so sorry to interrupt, but our activity block is drawing to a close in a few minutes.
Okay.
Would it be okay if we just open up for some questions?
Sure, that would be fine.
Okay. Does anyone have any questions?
I see Joseph does. Sorry, I can't hear you, Joseph. Oh. Sorry.
So one
Unfortunately,
thing
I
that you
can't.
said was that you avoid investing in trends and try and see in the long term. What current things do you see that a lot of people like are investing in that won't last 10 years? Maybe it's blockchain technology, which some people like and some people don't like, or maybe it's the newest hot trend. Like, what don't you see lasting?
Say the last, but what don't I see lasting? Well, I think you hit on one. I personally am a little bit skeptical of cryptocurrency. I think that this is something that has lasted a very long period of time, but I'm skeptical of the ultimate utility of cryptocurrency and the inherent contradiction. Crypto works because it's supposed to be a countryless currency, and yet now all of crypto wants to be regulated. And so you have this sort of conundrum. Well, is it countryless if it's going to be regulated by a country authority? So that's one example. I think there's some examples of things that I think people think are going to go out of style, but I don't think will go out of style. So they're what are called pipeline companies. These are companies that transport everything from fuel to other gases across the country. What they're finding is, as we go through the energy transition, they're able to think about repurposing their pipelines for carbon sequestration and for hydrogen transport. Hydrogen transport's a very complex issue because the hydrogen atom is so small that it causes penetrations in typical pipeline materials. But they are transitioning. I don't know how to think about the rise of EVs. There's so much technology that's coming up, much of it permanent and other parts of it that will be challenged. I don't know if you saw the recent announcements about, I think it's called Climeworks, figuring out a way to suck carbon directly out of the air. I mean, that could be a huge game changer, right? If you can get carbon directly out of the air, do you really need to cut back on certain types of carbon emissions, tailpipe emissions, etc.? Or will people, Ford Motor, GM, just pay to build these climate abatement systems to internalize the tailpipe problems? Yeah, I don't know the answer. It's just one has to think about what is the long-term trend and what's a trend that might turn over quickly.
I was also wondering how you manage the spending ratio between different donation, especially when the spending ratio between the various forms of investment endowments that you mentioned. When the ratio is bad, how do you manage the spendings? How do you recover?
Yeah. So in general, the payout rate is set as a uniform rate, and I don't know the full details, so I'll be a little careful. And if a donor wants to spend less than that, they can reinvest the amount. So let's say you're paying out let's say the endowment's worth 100 and you're going to get $5, and they say, well, for what I purposed this for, I only need 2. They can reinvest the $3. So, but they probably can't go higher, as opposed to going lower.
Thank you so much. Sorry, Zach, can I turn that? Okay. So the block is over, but thank you so very much for joining us today. This is a wonderful discussion, and thank you so much for sharing your perspective on endowment management and elaborating on what an endowment does. And thank you everyone for coming. Thank you so much. Have a great day.
Okay, my pleasure. Thank
Bye.
you, everybody.